Hey guys, John from Gutenberg Research here. I just wanted to do a quick overview of our GoPro earnings model. I know many of you who had GoPro shares long heading into tonight's release are probably freaking out at this point, trying to figure out what to do tomorrow at the open, whether or not to dump your shares. So hopefully this will help give you some perspective. So for this demonstration, we're going to be using the guidance in management's press release from tonight. And we're also going to be using our GoPro earnings model. So if you go to our website, gutenbergresearch.com, click on the models tab, scroll down to GoPro, you can download it for free. You just click this Excel icon. And right now I have the model calibrated to meet about the midpoint of management's guidance, but the ranges are actually pretty wide. So, you know, you do have some play here, and especially when you go out towards like 2017, 2018. So I'm going to freeze this model so we can just see the headings here, and we'll keep the valuation. You can see that we use a 50-50 valuation approach, so 50% weighted towards our price to EBITDA ratio and 50% towards the DCF. And I've calibrated it to meet about what shares are trading at tonight. So just a quick breakdown of how our model works. The top section is the income statement, which we model both on a GAAP and non-GAAP basis. Below that is the segment details. So you can see basically what drives earnings here. We break down GoPro's total revenue into units sold and revenue per unit, which we'll get into. The dark gray headings at the top represent the historic past periods, and the light gray represents the future forecast periods. Anywhere you see blue cells, those represent management's guidance, and I've input a comment to describe the ranges so you know, and really this is about going forward so you can keep track of how management's guidance changes over time. Then at the bottom of the segment section, we have our non-GAAP adjustment breakdown. So basically stock-based comp and amortization of intangibles. Then we have a section for non-GAAP EBITDA. So non-GAAP EBITDA is actually what we use for our valuation of our price multiple based valuation. Below that, we have a balance sheet ratios, cash flow statement, cash flow ratios, and then the assumptions for our valuation. So this is the assumption for our price to EBITDA. We strip out the net cash per share and value that separately. And right now shares are trading at about $9.50 a share, which is about 6 times our 2018 price to EBITDA estimate. Oh, this should be 2018. Had to move it out because EBITDA in 2017 is going to be about break even. So, and then there are our assumptions for our weighted average cost of capital and our discounted cash flow valuation at the bottom. So if you're not into discounted cash flow valuation, you can delete that section and really just focus on the market multiple. But for this video demonstration, we're really going to focus on management's guidance from tonight. So let's get to that guidance. For the fourth quarter of 2016, they guided revenue to $625 million. And the way we got there is we know it's the fourth quarter. There have some production issues, so demand seems to not be an issue, according to what management was saying on the call tonight. So we're going to see a sharp increase in the total number of units sold, assuming that the production issues are worked out in the fourth quarter. And then we set our average price per unit at $290. And if you look at how this metric has shaped up in the past, September quarter looks a little funny because they really didn't ship the units that they had originally anticipated they would. But back in June, they reached $291 per unit shipped. That $291 is obviously, it's not a real average selling price. It's more just a metric of revenue, total revenue divided by number of units shipped. So you can track through this and you can determine what you think is a correct average selling price or average revenue per unit. And then you can use historic seasonality to come up with the total number of units shipped. So we're showing a big spike in the December quarter, again, assuming that the production issues are worked out. And then we have the normal decline in the first quarter, stability in the second and third quarter of 2017, and then another increase in December quarter of 2017. And you can see that we get back to management's guidance of $625 million based on our assumptions of units shipped and revenue per unit. So the next piece of guidance that they gave was GAAP and non-GAAP gross margin of 40%. So we essentially just plug that in, 40%. Our non-GAAP gross margin is a little bit higher because we're taking out the stock-based comp and amortization of intangibles. but you can see it's plus or minus 40%. So we're basically the midpoint there. If you want to do a bull case, you could just plug in 41%, and you could see what impact that has on valuation and EPS. Now, keep in mind that our price to EBITDA valuation is based on our adjusted 2018 EBITDA. So if you change things in the next couple of quarters, it's not going to actually show up in the multiple valuation, but it will show up in the discounted cash flow valuation. So let me actually undo that because I want to keep this the midpoint of management's range. So 40% gross margin, diluted EPS of 15 cents. We're going to come back to that. So essentially, before we get to the bottom line EPS, we've got a tax rate of 12% and fully diluted share count of 146 million. So you can see we popped in the 12% for the tax rate, and for the share count, we got to 146 million. So when we do that, and the only other item that goes into the non-GAAP earnings per share is the stock-based comp, which we have at 4% of revenue. And even though stock-based comp has come up quite a bit on a percentage basis in the last couple of quarters, we do have it declining in the fourth quarter. And amortization of intangibles, which we just take the average of the last 2 quarters, which tends to stay relatively stable. So when we do that, we get back to EPS of 15 cents, which is the midpoint of their guided range, and on a non-GAAP basis, 30 cents. So you can see we're calibrated to the fourth quarter of 2016. That's not really where the fun comes in. So obviously it's not going to have much of an impact what happens in the next quarter on total valuation, because hopefully they're gonna ramp their production into 2017. And you notice that they actually gave guidance for the next full year. I think they were trying to get investors and analysts to push their valuations out further the way that we had to. So most analysts are valuing the company based on an adjusted EBITDA measure. But as you can see here, when we go through the 2017 guidance, we only got to adjusted EBITDA per share of about flat for 2017. So if you're applying any multiple to a flat adjusted EBITDA in 2017, you're not going to come up with anything for valuation. So I think they're really trying to get analysts to think past the production issues that are going on now and just really think far into the future. So the problem with the 2017 guidance is they didn't really do much in the way of revenue. They just said double-digit year-over-year revenue growth. So double-digit could really mean anything. For right now, we have our model set at 20%. But again, this is where you want to plug in your own values, and you can do your bull or bear case assumptions here. So the best way of doing that would be to change the growth rate in the units shipped and change the average selling price per unit. So right now at 20% year-over-year revenue growth rate, and then we got to go through the expenses. So they give GAAP operating expenses of $735 million for the year. So you can see we got to that by adjusting our assumptions for R&D as a percentage of revenue, sales and marketing expenses, and general and administrative expenses. So you can see for general and administrative expense, they basically were running in the double digits in 2016, and it was much lower in 2015. So we're assuming that they start to get back to a more normalized G&A ratio in 2017. And then for R&D, hopefully a lot of this R&D has already come up front in 2016. Based on the guidance for the total operating expenses of $735 million, it seems that it has in fact been already spent for the most part in the first half of 2016. So we have that ratio coming down quite a bit in the December quarter, which it always does if you look as a percentage of revenue. And sales and marketing, we still have it relatively high in the first and second quarter, and then starting to trail down in the back half of 2017. So using those assumptions, we get back to the GAAP operating expenses of $735 million. And then on a non-GAAP basis, they give guidance of $650 million. So again, the non-GAAP adjustments are really for the stock-based comp and the amortization of intangibles. So we have our stock-based comp coming down to a more normalized 5% or so of revenue, and the amortization of intangibles is relatively stable. So we're still just doing the average of the last 2 reported quarters, and we're just setting them all equal for the rest of 2017. So when we do that, our total non-GAAP adjusted OPEX, it comes in at 650 million, so in line with the guidance for 2017. And then they say they're going to be at a GAAP net loss for 2017, non-GAAP net income profitable, and then they give a tax rate of 15% and fully diluted shares of 152 million. So really the key there is getting to the 152 million shares, because we're not calculating our valuation based on net income. We're calculating it based on adjusted EBITDA. So in 2017, we get to basically flat adjusted EBITDA. By 2018, we're projecting a adjusted EBITDA profitable. But if we go down to our valuation section, you can see that it's only $1.33 per share of adjusted EBITDA in 2018, which is pretty meager relative to what our expectation was prior to tonight's release. So if we do 6 times the 2018 adjusted EBITDA per share on an X cash basis, we get back to the valuation of $9.50. And again, we're just, since we reset our valuation metric here, we're just using the multiple that will get us back to tonight's valuation. And this is so that you can use this as a tool to change the earnings assumptions and see what kind of impact it would have. So hopefully that helps, and you definitely download this for free. Check it out, plug in your own assumptions. If you want us to do some sort of specific scenario analysis, definitely let us know. Put some comments in the description below. And thanks for watching, and stay tuned. We'll definitely update this model after the new consensus comes out.